The silver market just took a nosedive. We saw prices plummet in a way that left a lot of people scratching their heads. The mainstream narrative says it's just supply and demand, a simple market correction. But when you look under the hood, a different story emerges, a much more calculated story. Today we're going to unpack the evidence and show you why this silver crash looks a lot less like an accident and a lot more like a deliberately set trap. What really happened? To understand this, we need to talk about two very different silver markets. First, you have the physical market. This is the real deal. The silver bars, the coins, the industrial metal that gets used in everything from solar panels to electronics. And in the physical market, demand is still strong. There are reports of shortages. Dealers are struggling to keep stock, and premiums are high. People want to hold actual silver. Then there's the paper market. This is the casino. It's a world of futures contracts, options, and exchange-traded funds. And in this world, you can use something called leverage. Leverage is like a financial superpower. It lets you control a huge amount of silver with only a small amount of your own money. For example, with 20-to-1 leverage, you could control $20,000 worth of silver with just $1,000. It sounds great when the price is going up because your profits are magnified. But leverage is a double-edged sword. If the price goes down, your losses are also magnified. And that's exactly what the architects of this crash were counting on. They saw a market flooded with optimistic traders, all leveraged to the hilt, betting on silver to go to the moon. This created a perfect storm, a massive pile of financial dynamite just waiting for a spark. And that spark was lit. Let's break down the mechanics of the trap. It starts with a small initial push to drive the price down. It doesn't have to be a big move, just enough to get the ball rolling. As the price starts to dip, the first wave of leveraged traders gets a dreaded message from their broker, a margin call. This means the value of their position has fallen and they need to deposit more money to keep their trade open. Many can't or won't, so they are forced to sell. This forced selling adds more downward pressure on the price. A lower price triggers another round of margin calls for the next group of leveraged traders. They are forced to sell. The price drops even more. Do you see the pattern? It's a domino effect, a self-perpetuating cycle of selling. This is what's known as a long squeeze or a cascade of liquidations. Each wave of selling triggers the next, creating an avalanche that completely wipes out the long positions. But that's not all. As the price falls, it starts hitting stop-loss orders. These are automated sell orders that traders place to limit their potential losses. So, as the price hits these predetermined levels, thousands of computer algorithms kick in and execute sell orders automatically, adding even more fuel to the fire. It becomes a machine-driven sell-off, completely detached from the fundamentals of the physical market where people are still eagerly buying silver. Now, let's add another layer to this. Right as this cascade was gaining momentum, the exchanges, the very institutions that are supposed to ensure fair and orderly markets, stepped in. And what did they do? They raised margin requirements. This is the financial equivalent of pouring gasoline on a fire. By increasing the amount of money traders needed to hold their positions, they forced even more people to sell. It was the final nail in the coffin for anyone who was still hanging on. Was the timing of this decision just a coincidence, or was it part of the plan? Think about the incentives. Who benefits from a crash like this? The big players? The institutional banks? The so-called smart money. They have the capital to withstand the volatility. They can even short the market, betting on the price to fall and make a fortune on the way down. They wait for the leveraged retail traders to get wiped out, and then they can swoop in and buy up silver at artificially low prices. They shake out the weak hands, consolidate their position, and set the stage for the next cycle. We also have to consider the role of the news. Just as the technical breakdown was happening, did you notice a sudden flood of negative headlines about the economy or some other market-shaking event? It's a classic tactic. Bad news creates fear and uncertainty, prompting even more investors to panic sell, which accelerates the crash. It all seems a little too perfectly timed to be random. When you see a technical cascade, forced liquidations from margin hikes, and a convenient news cycle all happening at once, it stops looking like a coincidence and starts looking like a coordinated attack. The proof is in the stark contrast between the two markets. On one hand, you have the paper market in absolute chaos, with prices crashing due to forced selling and algorithmic trading. On the other hand, you have the physical market, where premiums on coins and bars are rising because of overwhelming demand. How can the price of silver be crashing when it's getting harder and more expensive to buy the actual metal? It doesn't make sense unless you realize that the price you see on your screen is not being set by physical supply and demand. It's being dictated by the paper market casino. So, what does this all mean for you? First, this is not financial advice. The purpose of this video is to educate and encourage you to think critically about how these markets truly work. The key takeaway is to understand the risks of leverage. It can be a powerful tool, but it can also wipe you out in the blink of an eye. The game is often rigged against the little guy. The silver story is a powerful lesson in market dynamics. The recent crash wasn't just a random fluctuation. It was a well-executed trap designed to shake out leveraged traders and transfer their wealth to the big players. By understanding the mechanics of these events, the long squeezes, the margin calls, the stop-loss cascades, you can better protect yourself from becoming the next victim. Stay skeptical, do your own research, and always remember the difference between the paper price and the value of a real physical asset in your hand. Thanks for watching. If you found this breakdown helpful, make sure to like the video and subscribe to The Hidden Economy for more deep dives into the financial world. Let us know in the comments what you think about the silver crash. Was it a trap? We'll see you in the next one.